Well, let's go back to that story that we were revisiting. Sapna, we have discussed the various pros and cons. In a sense, this is to create tax clarity. In a sense, this is to break down and simplify the tax structure. Quickly tell us, what are the salient features that have been amended today and what exactly has been changed?
Well, very clearly, India gets a right to levy capital gains on sale of shares, from April 1, 2017, which are done by Mauritius residents. This starts from April 1, 2017. So this also means that whatever transactions are going to be concluded till April 1, 2017, they're going to be grandfathered. But this has been a long-standing demand on the part of India that we must get the right for capital gains, because you can't have a zero tax on both sides of the ocean, in the sense that no capital gains tax here in India, as well as nothing paid on the Mauritius shore. So it's going to be a done deal. That's one. Most critical takeaway is that. Also, if you want to bring down in terms of the rates, well, the short-term capital gains tax is going to be at 15%. Long-term capital gains tax on listed securities, in any case, there's nothing there. For unlisted securities, again, it'll be 40%, by foreign companies, and for unlisted long-term capital gains tax is going to be 10%. So the rates are also very much clear on that front. The second important part is that some transition phase is being given in terms of an inclusion of a limitation of benefit. In the sense, if an entity is, the size of the enterprise, the size of the business is worth 27 lakhs, that entity will be allowed a lower tax rate by 50%. So if you have a short-term capital gains tax, that will be lower by 50%. If you have a short-term capital gains tax on unlisted securities, that also will stand reduced by 50%. But this transition phase is there only starting from April 1, 2017 till 31st March 2019. After that, there will be no concessional tax rate at 50% in terms of any of the transactions that we have just spoken about. The third aspect, of course, is that even Mauritius-based banks having interest in India, there is going to be a withholding tax of 7.5% on them for any new loans given after April 1, 2017. So it also deals not just with share transactions, but it also deals on the banking side. It also covers banking operations, interest payments, and loans being given. The part here is very, the logic for all this is very clear. A, this has been under discussion for a very long time. B, of course, the guard is expected to roll out from next financial year, right? And under BEPS also, that is also something that is already in place. Under BEPS, you can't have a zero tax, in both countries. It may be capital gains, it may be some other tax that we're talking about, but you can't have a zero tax rate on both sides. So this was bound to happen. It's just that the announcement has come in now, and any kind of an exchange agreement now between Indo-Mauritius on these lines is not going to be in sync with what the international standards are. So it's not just that India per se on its own has kind of acted, but there are also global compulsions now. So keeping all of this in mind, it's going to be a fait accompli. The good thing is that there is a grandfathering period. They brought it in sync with the rollout of with the expected rollout of GAR, also with BEPS. So that's a good thing. And the LOB transition phase has also been given till 31st March 2019. Don't see any reason for industry or trade to be really upset about it. In fact, it will go ahead and give far more tax clarity than the confusion that was there earlier. Of course, mind you, in case you do not have the LOB, if you're not able to meet the LOB condition, then you're going to be treated as a conduit, as a shell company.
All right, Sapna, but hang in there. Stay on the line with us. We have Sudhir Kapadia of EY as well. Mr. Kapadia, thanks for joining in. How significant would this really be in tackling the issue of round-tripping of funds attributed to the long-pending India-Mauritius treaty?
I think there are 2 points. One is to the extent that there is round-tripping happening, to the extent that there is money washing happening, sure, it always helps that there is the tax exemption opportunity goes away, and let's say the tax cost of such so-called round-tripping goes up. And as I think I heard Lata say, that keeping in mind the objectives of the BEPS project and on tax transparency, this is welcome. My point here is that in terms of India's tax policy and in terms of let's say attracting this kind of investments, and when I say this kind of investments, I'm focusing not on the shady kind, but on the investments which come through two channels, right? One is the whole FPI window, or what was known as FIIs earlier, or portfolio investments. And the other is the private equity venture capital channel, right? Now, if you look at these two channels, what happens is that if those kind of entities make gains in India, which are either short-term in listed securities, or even if they are long-term, they are in unlisted securities, to that extent, you are taking away the capital gains tax benefit. One is, yes, of course, it gives level playing field to domestic investors, something which they have been asking for, and to that extent, it's fine. But two is, it increases the tax cost for them, or it decreases the after-tax return for them. Now, if you link it up to a potential, if there is a rupee volatility or depreciation, it then makes the after-tax return that much, the hurdle rate higher. So I think in the 2 years period, if everything goes well in the Indian economy, if the rupee really appreciates, the returns get better, I agree that it's just a tax cost which everybody else pays for making gains in Indian securities, and theoretically that is fine, but practically, if we are looking at some other jurisdictions around the world which do not tax non-residents for making capital gains on securities in their home countries, the economy will have to really generate that much better return.
But Mr. Kapadia, I think your point is taken, but Mr. Kapadia, in the first place, at some point in time, that crutch will have to go, and India will have to compete for economic benefits.
I agree.
And globally, there is anyway a move towards against companies using tax havens and against tax havens itself. So do you think it's going to be that big a disadvantage?
No, I don't think it's a question, Lata, of advantage or disadvantage. All that I'm trying to say is that, so let's step back. If you look at countries, countries who do not tax, it's not a question of tax havens, right? I'm saying under domestic tax policy, some countries have chosen conventionally not to tax non-residents on securities unless they are securities and immovable properties, right? Okay. So I'm only saying that it's a matter of domestic tax policy.
Yes.
That's it. So on unlisted securities for private equities and even short-term gains on listed, we will now have a tax. All I'm saying is that it's good that there is certainty going forward. You are giving a roadmap, over a period of 2 years, transition provisions. I think all that is salutary. It's not something that the tap is closing tomorrow.
Yeah.
All I'm saying is that I think the onus on India to give healthier returns and ensure that the rupee doesn't depreciate so badly.
Yes.
That the hurdle rate goes up.
Okay.
I
think the past 2-year record of the Indian rupee perhaps speaks for itself, and this confidence should come. It has been the more stable currency after being one of the fragile five. As well, the economy itself is in a sounder footing. This is the right time, it appears, that the crutch should be removed. We have being joined by more guests as well. Mr. Kapadia, Rajesh Gandhi, the partner at Deloitte Haskins & Sells, and Mr. Mukesh Butani of BMR Legal have also joined us. Mr. Butani, first thoughts, welcome, unwelcome?
Well, I think you have to give a context to why these changes have occurred. You have India as a signatory to the G20 BEPS project, which amongst various action points has listed abuse of treaty as one of the important objectives to which all the G20 are committed. So they need to look at reviewing all their treaties, which result in what the OECD calls it as a stateless income. That's the first point. So what India is doing is sending out a signal to the rest of the members of G20 that this is its commitment now to implement various action steps, and one action step being treaty abuse provision.
Yes.
The second important element that you need to bear in mind from a tax policy standpoint in India is the general anti-avoidance rules, which kick in on April 1, 2017. And with that, as it is, there was a degree of doubt and skepticism in the minds of investors who were making use of tax-friendly jurisdictions and whether GAR will kind of come in the middle of those forms of incentives that were available because of use of tax-friendly treaty. So that was the other aspect. The third aspect is that if you look at the regulations, draft regulations that were released insofar as GAR is concerned, this is in 2013, it clearly provided that the grandfathering provisions will be applied August 2010. And the reason that date was chosen was because that was the date on which the Direct Tax Code Bill of 2010 was released.
Fair enough.
So if you keep all of that in background, and if you look at the three changes that have been carried out, one, grandfathering up to April 17, two, a concessional rate of 50% between 17 and 19, in my view, augurs well. Besides the point that was made earlier on certainty. I also feel that how India could have, been able to live with the Mauritius-India Treaty with no capital gains tax. And it was one of those exceptional treaties where which was kind of going against the grain of source-based taxation and giving the rights to Mauritius to tax such income. So I don't really feel that this is something which is alarming and, it's going to cause mayhem in the market. Yes,
no, on the contrary, no. On the contrary, no, isn't it, Mr. Butani? Because it's grandfathering investments made up to April 2017.
More importantly, it's signaling that there is absolute certainty and clarity insofar as the policy is concerned. It is signaling that India is committed to avoiding stateless income, and it is propounding the concept of source-based income, which is there in all the treaties. Now, I know very well, now the investors will have to factor in this cost. So whether it's an FII investing in India, which tends to compute their NAV on a daily basis, will have to factor in this cost. But I think it's, in my view, an extremely sensible step forward by the government.
Okay. Well, do stay on, Mr. Butani. Rajesh Gandhi is also with us. Mr. Gandhi, you would agree that this is inevitable, considering that India has been a signatory to the BPS. The G20 was looking, sooner or later would want India to remove these tax anomalies. So this is just something that was inevitable and done in a very clean fashion?
Well, I'm happy that, India has been on the forefront on these tax developments on BEPS. India is on the forefront on some of the initiatives. And here, I think with this amendment, it shows a level of maturity in the Indian tax system, because finally we could make that bold decision. Every time there was any talk on Mauritius and P-notes, we were afraid that markets would tank and would have a big impact on foreign inflows into India and stuff like that. But I think finally we have that maturity now to, to do what was considered as dreadful, make an amendment to the India-Mauritius Treaty and remove the exemption. Of course, it will have an impact, especially for FIIs, institutional investors, asset managers, and to some extent it will increase their cost of investing into India, because some of these guys who are there from the US especially, they don't get a foreign tax credit for the Indian taxes. And that's probably one reason why they invest from Mauritius and Singapore. So it will increase their cost to some extent, but so be it. It definitely shows that India has matured in terms of, and India doesn't get kind of impacted by these small developments. The other important thing is it also affects the Singapore route, because the Singapore Treaty, as you remember, as you know, is tagged along with Mauritius.
So they get more investments from Singapore, you think, now?
No, so the tax exemption under the Singapore route also gets removed from April 1, 17. At least for Mauritius, we have this 2-year window where for 17, 18 and 18, 19 financial years, there will be a 50% tax as compared to the normal rate. But for Singapore, you wouldn't even get that. So that has an impact for all investments. And surprisingly now, Cyprus, which is a blacklisted country, continues to be the only one which gives you the capital gains exemption.
Oh, really? Okay, I have some data here put out by Live Mint, the Mint newspaper, saying that 36.5% of total offshore derivative instruments, that is P-notes, have been channeled through Singapore and 30% through Mauritius. So now should we expect that the P-notes registered of Mauritius go to Singapore? Mr. Gandhi?
Yeah, so, that has happened over the last few years, and I think the data which you are saying is more current, because if you were to look at the past,
yes,
then most of the P-note investments would have come from Mauritius.
Yeah, this is as of April, that's right.
That's right, because Singapore now gives more certainty in terms of the limitation of benefits clause, and, once you fulfill the 200,000 requirement,
yeah,
you are more or less certain that you get treaty benefits. But what will now be interesting is that while Mauritius will continue to get the 50% benefit for 2 years, Singapore doesn't get any benefit.
Okay.
So again, it will be interesting to see if there's a shift in the P-note investments and Mauritius gets a tilt over Singapore in the next 2 years.
Okay. Mr. Butani, what happens to P-note investments? You think, as Rajesh is pointing out, up until April 2019, it will be life as usual?
I don't know. One needs to sit and assess, because it will be too premature to come to a conclusion that one jurisdiction would be preferred over another jurisdiction. Because if India has taken this view as a part of the BEPS initiative, there would be equal amount of pressure that the G20 will exert on other nations as well.
Yes.
There is an expanded group for the BEPS countries beyond 20, which is a group of 45 nations, and Singapore would be a part of it. So I don't think that the future of international tax law will allow the kind of arbitrage that was being talked about earlier.
Okay.
It may be premature to comment on it at this point in time, but I have my doubts whether this arbitrage would be allowed, where investors would look at a jurisdiction over another jurisdiction. I think the fundamental point...
Are you seeing amendments to India's tax treaty with Singapore as well?
Again, as I had mentioned, it's premature, because one of the most important amendments that has happened insofar as Mauritius is concerned is India has asserted its right to tax the income which was the sole prerogative of Mauritius, which insofar as Singapore is concerned today clearly suggests that Singapore has the right to tax, and because Singapore doesn't levy tax on capital gains, you essentially have a tax-free income. But will India amend its treaty with Singapore? I think one needs to wait and see. The fact that the Mauritius treaty has been very carefully amended to provide a window until 17 and thereafter give a concessional rate of tax for 2 years would mean that India-Singapore treaty would come up for debate. And I'm using the word debate very carefully and selectively, is because I think to assume that the treaty will be amended will not be the correct thing, but also to assume that the arbitrage will be available from a medium to long-term standpoint will also not be the correct thing to say.
Fair point, sir. Well, finally, let me give that the same question to Mr. Kapadia as well. Sudhir Kapadia, what's your sense now? Will the Singapore window also be closed in the medium to long term?
Sorry, can you repeat? What was the question?
Do you see the tax advantages available to investments out of Singapore also getting eventually closed down?
No, the way I look at it is the Singapore Treaty, I thought when it was amended between the two countries was very clear that the capital gains tax benefit under the Singapore-India Treaty was co-joined. And I always called it the Siamese twins with the Mauritius Treaty. So I do have a slightly different view from what Mukesh said, because I would agree with what Rajesh was trying to articulate, which is that I just think that I don't even know whether the Singapore Treaty needs any amendment, frankly, because the treaty is very clear that the treaty will apply, or the benefit will apply, only as so far as India continues to grant capital gains tax benefit, to the Mauritius Treaty. So what may be needed is some kind of clarificatory protocol. But I doubt if there is any more arbitrage available under the Singapore Treaty as well, post April 1, 2017, of course.
Fair point. Well, Mr. Gandhi, Mr. Kapadia and Mr. Butani, thank you very much for joining in and clarifying a whole host of issues. Well, basically, all our legal eagles welcome the fact that there is certainty in taxation, that it is very cleanly grandfathered. The investments made up until April 2017 will continue to be beneficiaries of the double tax avoidance treaty. Thereafter, they are subject to 50% of taxes which the Indian government levies, and from 2019 onwards, they would be taxed like any entity in India itself. No special treatment, no tax avoidance or exemption to capital gains arising out of investments made by Mauritius-based companies. This sets to rest a 2.5-decade-old conundrum in the Indian markets, tussle in the Indian markets, and now I guess India has the maturity to say that tax crutches are not needed for those who want to come to India. India is anyway an attractive destination, and this crutch was anyway going, because world over there is a movement against tax havens, there is a movement against specialized tax treatment and tussle between acts which are designed purely to attract investments over and above without taking cognizance of tax disadvantages to the home country. This sets to rest a very important controversy, and in a manner that will immediately not affect the Indian share market, since anyway the date is April 2017, and even thereafter there is 2 years of just 50% tax available. I would assume that the stock markets will look at this as a very, very positive development. We have gone on for a goodish bit. We will take a break, but we are not done with our analysis of this very important change in the Indian tax regime. We'll be back with more experts after a very short break.
Well, we've been tracking the big breaking story at this hour and getting you a detailed analysis on India's tax treaty with Mauritius. To take you through the key salient point, 3 key salient features have been amended today. You had a significant guest outline the pros and cons in many areas. So let's just go through them one by one. One is that with this new amended protocol, India gets taxation rights on capital gains arising from the alienation of shares, and this will be acquired on or after the 1st of April 2017. So that creates a grandfathering of about 2 years for the investments. Now there's another very important, the second and perhaps the second most important feature of this is the limitation of benefits, that is the LOB. The benefit of about 50% reduction in tax rate during the transition period 1st April 2017 to the 31st of March 2019 will be subject to LOB, and here a resident of Mauritius will essentially not be entitled to benefits of 50% reduction in the tax rates. We'll take you to the exact breakup of the current tax rates and the exact impact as well. We'll try to get you more reactions on how significant this would be in creating tax clarity and in avoiding tax evasion and tax avoidance that this treaty is trying to obtain. All right, we have Pranav Sarita of EY. Thank you, Mr. Sarita, for joining in. To begin with, you've gone through the key salient features of the amended agreement. How significant would this be in creating tax clarity between the two countries? And do you believe that this creates a better case for India and Singapore to thereby amend their treaty?
I think this is an extremely far-reaching development, and it could significantly impact tax structuring going forward. Under the India-Singapore Treaty, the way it is currently worded, I think it will automatically stand impacted because of the way in which it is currently worded. So if the Mauritius Treaty changes, there will be a corresponding change impacting the Singapore Treaty as well. In a sense, any investments made up to 31st March 2017 are grandfathered, and that would mean there is actually an incentive or an inducement to invest upfront, the sooner the better, so that if a person invests before 31st March 17, his capital gains in India will always remain tax-free for all time to come in the future. And in that sense, to some extent, at the front end, in the immediate term, it can actually help because the investments made immediately or before 31st March 2017 will actually always enjoy the capital gains treaty exemption. And in that sense, I think for the immediate term, it might be actually helpful or might accelerate anyone who is wanting to make investments into India might want to make it before 31st March 2017. But overall, in the longer term, of course, investments into India will now have to factor in the fact that there will be a capital gains tax on exit. So to that extent, it's a very far-reaching development and an extremely important one.
Mr. Saida, are you saying that investments upfront will now be easier before 2017? So are you expecting an increased inflow of upfront investments made by FSIs, FFIs or asset management companies? All right, Mr. Saida, just hang in there. We have Shaktikanta Das, the Economic Affairs Secretary, joining in. Mr. Das, appreciate you joining in on this show. Tell me, this of course creates significant tax clarity between India and Mauritius. What is the basic move that the government is trying to obtain with this, and how significant would this be in creating tax clarity over the long term?
You see, first thing is that this has been under negotiation, under discussion with the Mauritius side for a pretty long time. And even last year also there were some discussions. We thought we had made a headway, but then, it could not be sort of concluded. So it's very heartening to note that the Revenue Department has now concluded this amendment to the DTAC with Mauritius. It, number one, it addresses the concern of the government with regard to possible round-tripping of money, possible round-tripping of unaccounted wealth from India, number one. Number two, it provides a grandfathering provision. There is a grandfathering provision for investments up to 1st April, that is up to 31st March 2017.
Yeah.
So all investments prior to 1st April 2017 are grandfathered. So it is not as if the market or the investors are taken by surprise. Sufficient advance notice is being given.
Yeah.
And the next point I would like to add is that thereafter, for the next 2 years, up to 2019, the tax will be at the rate of 50% of the normal rate.
Okay.
So therefore, it's a benign transition, a phased transition from a zero capital tax, capital gain tax regime to a normal capital gain tax regime over a period of up to 17 and thereafter 2 years. So over a period of 3 years, it's a transition. So I think the market should accept, markets should be able to absorb this. And in as much as there is a grandfathering provision, I would expect a surge of investments coming into India, especially FDI coming into India before 1st April 17.
Yeah, Mr. Das, actually FDI wasn't a big issue because people were not running away with, liquidating and claiming capital gains exemption. The problem really is for the FPI, the foreign portfolio investor. Now, here comes the first confusion from the market. Anyway, the GAR becomes applicable from April 2017. So which will prevail? Will GAR prevail, or will this 50% exemption granted to investments out of Mauritius?
Now, you see, the GAR, that was the earlier version of GAR, but now in as much as there is an international treaty, this aspect will be examined when the GAR is taken up as a part of the next year's budget. So it is something I would not like to prejudge. But having said that, I would mention that naturally when there is an international convention signed between two sovereign countries and India is a signatory, naturally whatever India signs as a part of this amended DTAC, GAR will take care and take note of these amendments appropriately. Obviously, GAR cannot ignore what we have signed with Mauritius.
Okay. What about the treaty, the kind of capital gains available with companies investing from Singapore? Will that prevail, or will GAR prevail? Even over there, you would assume that the sovereign agreement, the agreement between two sovereign countries will be more important than GAR, so the Singapore window will still be available?
With regard to Singapore and also Cyprus, the current double taxation avoidance agreement says that, it is linked to our renegotiation with Mauritius.
Okay.
So now that we have renegotiated with Mauritius, and we have arrived at this revised agreement, so naturally to that effect, the Singapore agreement will also get modified.
Okay. So actually the word used is co-terminus. So the word used, I believe, is co-terminus.
That's right, yeah.
So, therefore, investments from Singapore also after April 2017 will be taxed to the extent of 50% of a normal Indian resident tax. And after 2019, investments out of Singapore will also be taxed like investments from any other country?
These things, the official clarity in these matters will be sort of issued by Revenue Department as we go by. And, the Revenue Department would be issuing official clarification. I don't want to prejudge the issue. But yes, the understanding is that whatever we agree in the case of Mauritius will be applicable in the case of Singapore also. Now, since we have renegotiated the Mauritius thing, Singapore is another sovereign country with which we have to renegotiate and bring in whatever has been done here to the India-Singapore agreement.
No, I mean, no two ways about it. This is extremely welcome certainty and extremely welcome confidence on the part of the country that we don't need tax crutches to attract investments into the country anymore. Another point of discussion or confusion in the market stems from what your predecessor told us, sir, after the budget, Mr. Adya. He was saying that no country...
He's my successor. He's my successor.
I'm sorry.
Yeah.
Okay.
Yeah.
He was saying that anyway, no country offers complete long-term capital gains exemption for portfolio investments, and therefore a long-term capital gains tax is on the way. That was very much a discussion during the budget and before the budget. So should we assume that all this clarity and certainty is paving the way for probably an imposition of long-term capital gains tax next year?
No, I can't prejudge that. It's a tax matter which will come as a part of the budget. I cannot say that, which tax will come in the next budget.
I agree. But philosophically and in principle...
But having said that, let me add that the amended protocol now creates a level playing field between domestic investors and the investors who had an unfair advantage when they came to the Mauritius route. Yes. So now there is a level playing field. Number one, I would like to mention. And number two, even for FPI, I mean, you mentioned earlier that we are talking of FPI and not FDI. Now, even in the case of FPI, let me say that Indian market today, Indian markets are offering very good return comparable to what investors from, investors should get in other jurisdictions.
Absolutely.
So therefore, the flow of investment will definitely continue into India. After all, how many countries are there today which record a 7% plus growth? Absolutely. And which offer the kind of decent return which Indian markets are offering?
Oh, absolutely. And with a stable currency. So even the currency has not eaten away benefits like they would have eaten in the other countries. I take your point completely, sir. Now, therefore, should we assume that P-notes as a product dies after April 2019 at least?
I think you have to have patience. All these things we will issue clarity as we, go by. We will have to be a little patient. But this is, something for which I must say that I would compliment my ex-colleagues in the Revenue Department for having taken it forward and having concluded it. And this not only brings in tax clarity, it, sort of that suspense which was continuing off and on, it gives clarity. And then it's a benign and a very smooth transition into a, into a regime whereby we will have the full taxation, because there's a 1 year window from now to April, and again thereafter another 2 years. Where 50% will be, 50% of the tax will be levied.
No quarter at all.
It's a very phased and benign process of transition, and I think investors, I would expect investors to take a very reasoned view of the whole matter, and in fact, I would feel that there would be a surge in inflow of investment.
Yeah, I mean, full marks as far as predictability and the equity that underlies this amendment, sir. But now from the point of view of someone who's so close to the exchequer, will this mean lower flow of amounts or higher flow of amounts? Because you have a larger universe to tax.
Naturally. I
mean, more tax, more money in the kitty?
Yeah, naturally, but that will come only after 1st April 17.
Yes. Yes.
That will come only at a future date. So for the next financial year, 17-18, we will have the benefit of this additional revenue into the government kitty.
Yes. And after 19, even more.
Naturally, yeah.
All right. Mr. Das, thank you very much for joining in and clarifying the other confusing issues with respect to the investments from Singapore and the longer-term nature of the amendments that were brought in today. Thank you very much for joining us.
All right, Lata, we'll take another quick break on that note. Our analysis will continue and we will get you all the other news of the day on the other side. Stay tuned.